You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cashflow Podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here. I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is real estate investment expert, Sean Katona. Now, Sean is a real estate investor, landlord, and national speaker, and owns income property across 4 states and has spearheaded 70-plus deals ranging from value-add renovations to new construction. Sean's focus is revitalizing retail shopping centers and apartment buildings to maximize returns for friends and family. Now, prior to making the transition to full-time real estate investing, Sean spent 7+ years selling advertising solutions to Fortune 500 companies. He holds a bachelor's degree in business administration with sales, marketing, and information systems concentrations from the Foster School of Business at the University of Washington. Outside of real estate investing, he loves international travel, scuba diving, golf, and snowboarding. And so, guys, in today's show, we're going to be focusing on Sean's interest in the retail sector and why he's so drawn to this asset class. And now, I've been following Sean on Facebook now for the last couple of months, and I've been quite impressed at the sheer activities that he's had in the value-add retail segment. And I know a lot of folks out there will argue that, you know, with the age of Google and services like Uber Eats, there's less and less need to go to a physical store, right, to a brick and mortar store. And I have my own arguments to this, but would love to hear Sean's perspective and, again, why he's so interested and targeted in the retail sector. Because, again, he's been making a lot of big things happen, and I'm very excited for him. So, again, also excited to kind of pull back the curtains here. And so looking forward to getting onto the show with Sean. But before we do, I just have a couple quick laundry list items I'd like to run through with you guys. First and foremost, I failed to mention it a lot of times, but I want to make a mention of it today. And that's we're in deal acquisition mode today and pretty much all the time over here at our company, which is Sunrise Capital Investors. And we focus on mobile home parks. And again, we're always looking for opportunities. So if you're out there on the hunt, just looking for general deals and you run across a mobile home opportunity that's maybe 60 lots or larger in size, please think of us. You can simply reach out to me via my contact page at my website, kevinbupp.com, or our company website, which is sunrisecapitalinvestors.com. Again, we're seeking mobile home parks across the U.S., okay? We're in 11 states today and are slowly growing that. We're adding state by state, month after month. So we'd love to add more to our portfolio and would love to work with you to do that. Next up, we just opened up the second tranche in our Mobile Home Park Growth and Income Fund. And so if you're an accredited investor and you're interested in partnering with us on acquisitions, please visit our secure investor portal by going to, again, our company website, sunrisecapitalinvestors.com. There you'll be able to access our PPM and overall investment summary. Lastly, if you happen to be in the Tampa Bay area, which is where we're based, I'd love to connect with you during your visit. So if you have some free time while you're here, simply reach out to me by going to the contact page on my website, again, kevinbupp.com, and just submit a message and let me know when you're going to be in town and what kind of availability you have, and I'll get back to you. And one cool thing, this is only if you have an interest, you're only going to think this is cool if you have an interest in the mobile home park niche, but one cool thing about the location of our newest office, we just moved offices about, I think, 4 or 5 months ago, is that right down the road from us, literally a block away, is the Jacobson manufactured housing plant. So it's where they make mobile homes, literally a block away. They've got a huge, I think, 300,000 square foot facility, and it's where the sausage is made. So our niche is mobile home parks, and it's kind of neat to have that right down the road. We didn't really plan it that way. It's just kind of worked out that way. So if you're here for a visit and you like to see our niche and how it really, gets from a frame built into a home, I'll take you down there and give you a tour. All right, guys. So without further ado, I'd like to welcome our guest for today's show, Sean Katona. Sean, how you doing today, my friend?
I am doing great, Kevin. Good to be with you.
Yeah. I'm excited to have you here. And, Sean and I, we chatted. It's been a while, Sean, right? A couple of years at least 2 years, I would think. We had a phone call a while back when you were kind of, you were in single family, you were dabbling in the retail. And I don't know if you had bought your first retail property or not yet, but I remember you doing a lot of direct mail and you getting some responses and us talking about some deals. And so that was, probably 2 years ago, maybe not that long. My memory is not all that great as I get older. I kind of lose focus on time, but you've had a lot of activity over the last year at least, buying multiple properties and some very large properties at that. And so very excited to get an update from you and to, again, have you on the show here and share your story with the listeners. So with that, I gave you a fairly brief introduction. Your background's much more expanded than what I give you credit for. So maybe take a few minutes, Sean, if you would, and tell our listeners a little bit more about yourself.
Yeah, sounds good. So my origin story, I guess you could say, or how I got started in real estate, I think is like a lot of other folks out there doing this business. I was working in corporate America, as you mentioned, for Microsoft and then EA Sports, selling marketing and advertising packages to Fortune 500 advertisers. So it's neat to get to see how the biggest brands in the world build their platforms, build their audiences, and ultimately provide value to consumers. Mm-hmm. And as I was doing that, I was, socking away some chips, saving up a little bit of money, and got to a point where I had a bit of a nest egg. And I'm asking, what do I do with this? Where do I invest it? And, I had read Rich Dad, Poor Dad, and I'd seen, other people have some success in real estate. So I just went out and attempted my first rental property. It didn't go as planned. I fumbled along with that deal and subsequently a couple others, and eventually reached out and got some help and support and some coaches and some mentors to really guide me. So that allowed me to go into real estate full time in 2013. I guess I bought my first deal in 2009. So I was able to make a living off of it and really focused on flipping houses, doing wholesale deals, buying more single family rentals. I had a duplex at that point. And, over the last couple years, I've really started to steer the ship a little bit more towards commercial. When I think, as you and I both know, when you start to really understand that asset class mm-hmm. and how it works and the cash flow, the principal pay down of the loan, the depreciation on the building, the appreciation of the building, if you really grasp that, it makes so much sense to play in that arena and maybe a little bit bigger game. And so for me, it kind of became an opportunity cost. Like, do you do many smaller deals or focus on a few larger, potentially higher quality deals mm-hmm. That could put more in the bank and could offer more attractive returns to my friends and to my family who have participated in deals with us. So yeah, I guess that's a little bit of the back history. It's been, like you said, everything from single family to multifamily. We have, a pretty good sized apartment building in the portfolio, but I do focus predominantly on retail now. I'd say I spend 90% of my time. And I do that in the Phoenix market where I live in Orange County. So it's close enough, but I still get some pretty good returns. Unlike, my backyard here, we might be buying 3 or 4 cap deals.
Right. Very, very interesting. So I want to ask you the question, I was going to ask you the question, why retail and why not, some of the other commercial asset classes, whether it be multifamily, self-storage, office, the list goes on and on. But you own multifamily, right? I mean, you said you own a fairly large apartment complex. And so it's interesting. And I'd like to hear your perspective on why you decided not to pour more of your focus onto building that multifamily portfolio versus going the retail route.
Yeah, I love multifamily, and I think it's probably the safest, most stable asset class. And I don't think mobile home parks are any exception to that. But I think it also is well understood by everyone else. So if you're going from single family into commercial, that just seems like the most natural fit. And I agree. Yeah. If you rehab rental houses, everyone can grasp it. Like some of the other asset classes, industrial or retail, there's just so many other nuances. They're a little bit harder to maybe grasp or have a longer learning curve. So, when I really started pursuing this, the market felt like it was at an all-time high. You see deals going down in 3 and 4 cap, maybe 5 cap returns. And so it just, for me, felt a lot more competitive to find a quality multifamily deal where I could go in and add significant value, force appreciation.
Mm-hmm.
Not to say that I wouldn't do one. I'd love to own, thousands of units at some point. The larger building that we own is part of a syndication. So we're a passive investor in that. It's a $30 million asset. And I love that it adds diversity to the portfolio. So we've got some single family income coming in. We've got our multifamily units. We've got the larger apartment building. We've got a number of shopping centers. And so it just starts to create something that at least makes me feel a little more comfortable, a little bit more recession proof, maybe a couple asset classes, a couple geographies.
Got it. Let's talk about the first deal, the first retail deal. I want the show today is going to be focused solely on the retail side of your business. I know that's where you're spending a lot of your time today. And so I'd love to hear about that first deal. That's typically where the foundation is laid, right? And a lot of the initial mistakes are made. You kind of get your footing a little bit and determine what the overall rest of your business model is going to look like moving forward from that very first deal. And so tell me about when you bought it, what it is, how you found it, all the details, all the intimate details, if you could.
Yeah. And I'll bring you through the gory stuff that's not quite as sexy to talk about. I started learning about commercial and retail years before I actually took that deal down. In full transparency, it took me a lot longer than I thought it would. I had quite a few false starts where I offered or maybe even entered a contract in escrow and just found things about the building that I couldn't get comfortable with. So I killed deal after deal after deal and probably wrote dozens, if not hundreds of LOIs up before I finally found one that I felt was a slam dunk and could be turned into, let's call it a solid double at the very least. So let's see, that acquisition for me would have been late 2017. It's a property just outside of Phoenix, kind of a suburb or bedroom community. It's a 20,000 foot retail shopping center. You could call it a neighborhood center. It was bank owned. All of the leases more or less had burned off. So there was not much term or stability or predictability of income when we entered the deal. So the assignment on that one was really to stabilize the rent roll, fix up some of the deferred maintenance, bring the rents to market, and then put ourselves in a position to either refinance or test the market or just buy and hold for a long time with a good, stable, predictable tenant base.
Got it. How did you get comfortable with that tenant base that was there, being that there was really no term left on their leases? So, I mean, for all you knew walking into it, you go in, let them know you're going to do some improvements, and ultimately you're going to be looking for them to sign a 3 or 5 or maybe even a longer lease. And they might say, no, I'm not doing that, right? I'm going to move on, right? I'm going to move somewhere cheaper or whatever. I mean, you've got that risk there of people vacating that space. So how did you mitigate that risk?
Yeah, great question. I mean, we had the opportunity and due diligence to do tenant interviews. And our seller, a bank, was really, really cooperative. They liked me or us, our group as a buyer, and really allowed us to do some things even before closing to set up for success. Coincidentally, that bank ended up doing our loan on the property. Okay. So it almost had the feel of seller financing, which is so unique, but they were obviously very comfortable with the asset. They understood it, they knew it, and they were happy to get it, off of this part of their books and onto the right side of their books where it was, an asset versus a liability.
I always like to know the story behind the prior owner. You mentioned that was a bank-owned property. And so ultimately, why couldn't that prior owner make that deal work? Do you know the story?
Before the bank took it back?
That's correct, yes.
Yeah, I mean, I didn't interview the guy, but I suspect he had a much higher cost basis, probably a much larger loan, and that maybe, things slow down with a tenant or he gets involved in who knows how many other projects, just reached a point where he could no longer service the loan or had the energy. I mean, it's probably how most of those types of deals. Yeah. So I don't know the exact circumstance, but my understanding of the prior purchase price and debt load was, it's something along those lines.
Got it. So what was the first step? So you guys closed on the property. You had those tenant interviews prior to the closing during due diligence. So you got a good, comfortable feel that these tenants were going to stick around, more than likely willing to sign leases, longer term leases. And so what did that look like when you guys actually hit the ground running? Closing day comes, and now what?
Yeah, it worked really nicely in that we had a couple of the renewals essentially locked. You know,
Okay.
the LOIs had been done. And so upon closing, we were able to immediately execute a couple of the leases. And so you just hit the ground running with momentum. And you know, that makes your bankers feel good. That makes your investor partners feel good. You know, you're able to report back to your wife and say, hey, hon, we're doing great. We've upped the income already. We've got some predictability and some stability here. So that was great. And then, you know, we started digging into all the things that were discovered, the little things on the property. So right out of the gate, we improved the landscaping. We resealed and restriped the parking lot. We upgraded some of the lighting to LED. Mm-hmm. We did an it was an exterior paint job of the entire building. We removed some old signage. And so when you see that happening in the community, with a building that's maybe been tired and kind of let go or forgotten, or, you know, the bank is not in the business of managing property, right? They want to earn money. And so it's not rocket science, but you go there, you do those things, and people take notice. You know, the tenants see that. The customers of those businesses see that. And so it helps us to be able to tell the story of new manager, you know, new owners here who want to improve the center, who want to help drive foot traffic into your businesses. And, you know, the stance that I take is, what can we do to help you grow your business? Mm-hmm. That might be little things with co-marketing. That might be holding events. That might be helping them with new signage, creating a new monument in front of the building where they can get more foot traffic, creating a better mix of tenants in the building. So what is going to be complementary to each other versus, you know, hey, these two aren't getting along well. Why is there, you know, a bar next to, you know, Alcoholics Anonymous, whatever it is? Like, that's not a good thing, right? So those were the first things that we looked at. And then, you know, once we had some of those things to showcase, we start having the conversations with each tenant. You know, what do you love about this location? Is there anything that you'd like to have done that hasn't happened in the past? And then, you know, eventually with tenants who are maybe significantly below market or have no term left on their lease, you know, here's what a new deal would look like. You know, if that makes sense for you, great. We'd love to put one together. If not, you know, our plan is to backfill this with a new tenant. So we're probably half and half, you know, with renewals of existing tenants, maybe a little more than half of renewals, and then bringing in some new tenants, either from less desirable locations in town or who are opening up a new business in town that loved what we were doing there.
So you ran into your projections, then you had the ability to do that due to your tenant interviews during the due diligence period, that you're going to have some turnover, right? I mean, you were going to turn a number of those units and have some downtime. I mean, did you kind of factor that in? Yeah.
And okay. That's exactly what happened. You know, the businesses didn't make sense. Ironically, it was sold right after we closed to a different operator. And so, you know, she just wasn't able to execute, and we had to, you know, repurpose that suite, and we ended up demising a larger box down to 3 separate users and 3 separate suites, which allowed us to increase the income. You know, each of those smaller boxes rented for a little bit more per foot than a larger deal, which isn't uncommon, but that was a great way, you know, by doing a little bit of construction, demising, and doing 3 deals instead of 1, that increased our rent roll.
Yeah. Okay. Fantastic. So what's the long-term plan for this property? I mean, you've got it stabilized now. It sounds like you've got local bank debt on it, which probably has got a 5-year balloon in place. Maybe you correct me if I'm wrong. But do you have a long-term strategy as far as putting some higher quality, longer-term debt in place at some point, or?
Yeah, this was unique, and I don't know if this will happen again, but that bank got so comfortable with us as a buyer. You know, they saw my resume, they saw my track record, you know, more in the residential space and owning properties and being able to manage things and doing turnarounds, that they gave us essentially a long-term fixed rate loan. I guess long-term is relative. So, you know, we landed that at 4.8% interest. It was a 5-year lock. It's got a 5-year float after that. It amortizes over 20 years. And, you know, what I'm seeing mostly with bankers is their term kind of matches up with the tenant leases. So, you know, we've got 5-year deals, we've got 7-year deals in that building. And so they feel comfortable doing a 5-year fix on that.
Got it.
And then if they need to adjust, they will.
Okay. How about the management side of the business? I mean, are these triple net leases through and through?
Yeah, which I love.
Yeah, well,
that's one of the amazing parts of retail.
Yeah. So for the folks that don't know what that means, please define it for us, if you would.
I don't know if I'm a triple net expert. So my understanding of it is that essentially we're passing through a lot of the operating expenses for the building. So triple net, and there's absolute net lease, like a McDonald's deal where they're covering everything, including the roof. What we cover on this building, or I should say, what our tenants do, what gets passed through is the insurance, the taxes, and the common area maintenance.
Got it.
So that'll include things like their landscaping and their trash and their utilities. And so that's all billed back to the tenants proportionally, depending on their size of the building.
How about mechanicals, like such as plumbing and air conditioning, heat, and things of that nature?
Yeah. So in most of the new deals that we struck, I have them covering a certain amount of the HVAC units, which in Arizona get burned 24/7 almost. And so they might cover the first, let's say, $1,000. And then anything above and beyond that, the landlord would handle.
Got it.
And that varies by lease, right? We could have structured the lease such that they cover it completely. And many of them are written in that way where they're supposed to have a maintenance and a regularly scheduled person coming out and taking care of those units. Or you could have it the opposite. So it does vary deal by deal. But we have it set up as a little bit of a hybrid where, hey, we're not going to put it completely on you if your $8,000 unit goes out.
Right.
And you're only going to be here for 2 more years.
And so in those leases, I'm assuming that you've got some kind of escalator each and every year that at least compensates for inflation.
That's another thing we love about retail, right? Yeah. And that gets locked in when we sign the lease. And so like maybe compared to, some of my single family rentals or the apartment buildings, all the work in retail seems to be front loaded a little bit more. So it was a lot of work for a couple quarters getting all those renewals done and getting, the rents up to market. Then they sign a 5-year deal or they sign a 7-year deal. It's got 3 or in some cases 3.5% bumps on the rent to keep up with inflation. And so they know that going into it. We know that going into it. We can model it. The bank can model it. Our investors can see that. And so everyone feels good. It's like, yeah, today this throws off hundreds of thousands of dollars of income. Tomorrow it's going to be 3.5% more than that.
Yeah. It's a beautiful thing.
And it's predictable and you can underwrite it. And, we can even, let's say if we're going in for a refinance and appraisal, or we're reselling the building, underwrite against that and say, hey, today it's throwing off this much money, but tomorrow it's going to be more. And so you can sell some of the future value of that as well, as you know.
Yeah, absolutely. Yeah, that's fantastic. Well, I want to talk about some of the things surrounding risk associated with technological advancements. We talked at the very beginning here, Google, right? Amazon, anyone. I mean, my wife, she drives me crazy because there's literally packages at the door every day, right? I mean, we literally didn't even go to a brick and mortar store to go Christmas shopping this year. And I don't think we have for the past 3 or 4 years.
Yeah.
It's just... I personally don't like having to go to stores if I don't need to. That's just me. I even buy clothes online now, which is crazy because half of them I send back because they don't fit right. I got this whole packages come, ship them back out, and but I don't go into a store. And so, how do you foresee that affecting retail as we move toward the future here? In addition to that, you got things like self-driving cars and even Uber Eats. I mean, so if you got restaurant tenants in your buildings, ultimately how does that affect, how does Uber Eats or, I know grocery stores now are delivering, they might need a smaller footprint in the future. How do you see all those items affecting the need for the standard brick and mortar retail as we move toward the future?
Well, how's the saying go? The only constant in business is change, right? And I think retail is experiencing a lot of that right now. And you see some really, old companies that have been around for 100 years in some cases that haven't adapted to some of this change. Yeah. So you think about the Sears of the world and a lot of these folks going to smaller footprints, and you think about your own habits and they're changing a little bit. And so I think that's why you've seen industrial become a really, really hot sector, because everyone wants to do just-in-time delivery to somewhere around their neighborhood. You can get stuff on your doorstep in 2 hours now. So that certainly changes things. So does Uber Eats and Grubhub and DoorDash. But think about all the things that you do leave the house for. Like, I haven't figured out how to get my hair cut on Amazon yet. Or, my wife still gets her nails done down at the salon, as much as we have delivered to the house, because we have an 18-month-old now. So leaving the house is a true adventure, and there has to be some serious value at the end of it. So we get a lot of food delivered, but we still go out to eat a lot.
Yeah.
So the restaurant users, working out in gyms, like, there's still a lot of service-centric uses that make sense for retailers or businesses to have a physical presence. And so that's kind of the niche that I've leaned towards. And I think you see a lot of investors saying, hey, is it Amazon resistant? What is e-commerce going to do to this business model? Is it a service-centric neighborhood use where they're going to come back a couple times a month? So if you look down my tenant roster on a couple of these buildings, it's a dog groomer. It's a dance studio. It's a nail salon. It's a barber shop. It's a local insurance agent who wants to have an office where people come in and out of. It's a smoke shop. It is a physical therapy location. It's a restaurant, bar and grill. So it's those types of uses. And no, it's not Starbucks. Would I love it to be? Yes. Chipotle, yes. So we're talking about a mom and pop tenant base, but their business is doing well in this environment. I don't think they're getting cannibalized like the Searses of the world, the J.C. Penney's of the world, which probably needed to reinvent themselves a little bit. They relevant.
Sure. Okay. Well, that kind of leads me into my next question. That's finding the right tenants, right? Finding the right credit tenants that are going to be there for the long term, that have stability, that are financially responsible, that are ultimately going to, survive the term of that lease and pay on time. What does that process look like? Give us an idea of when you started looking for new tenants to fill those vacancies in that first building. And I know that you bought some other buildings as well and you've had vacancies. So maybe just generally speaking, what does that exercise look like?
What's really nice now is the data and the technology tools that allow us to understand and interpret that data is so good, So, we subscribe to CoStar. There's tools like Esri and what the CCIM brokers and leasing agents use. And you can literally hone down on a building, a site, and say, hey, in a 1, 3, and 5 mile radius, what are consumers spending in this neighborhood? What are their demographics? How much do they spend on electronics? How much do they spend on beauty? How much do they spend on all of the categories? And you can see where there's a surplus and then where there's excess and where there's underserved and where they're oversaturated. And then we can reverse engineer that, understand it, and go out to the leasing community of brokers and say, hey, here's the target list of who we should go after for this building. Like, if someone opens up a shop here, the data says that there's probably going to be this many sandwiches sold or this many donuts sold or this many cups of coffee that get sold. And so it really helps to reduce the risk for a retailer or a business owner opening up a practice or a larger franchise, maybe opening up another location. Say, the data supports that 30,000 cars a day pass in front of this shopping center. And so we know our numbers. And based on that, this is what our sales would probably look like.
Got it. And so you guys do use leasing brokers to fill in your vacancies.
I'm a big proponent of that. And
Okay. Why is that? I mean, just random question, but why is that? I mean, versus just if you have the data and you have the resources to kind of identify who might be the ideal fit as far as the end retailer, where's the benefit of bringing the broker into the equation?
Yeah, even since my single family days, I've been a big proponent of compensating brokers well because they control so much of the deal flow. They control the tenants. And so if I can pay my brokers well, they're going to bring me more deals. They're going to want to bring me more tenants. And they almost start working for me versus all the other landlords out there. Or even their sellers in some cases. And so wherever I have the opportunity, I want my brokers to be able to double end a deal. So they bring me the deal, I'll give them the listing back in an ideal world. If they can bring me a tenant, they might have a shot at relisting that building down the road. If they can rep both me as the landlord and their tenant, they can make double commission. And so that incentivizes them to want to come to our building. And, I've got it modeled in the numbers where let's pay that commission. We have that underwritten because that's what gets these deals done.
Yeah.
And not every landlord is willing to do that. So a lot of these guys are saying, hey, I'm not going to throw any tenant improvement dollars at it. I'm going to pay, mediocre commission. I won't do anything to cut these deals. And that's what boosts the income of these properties. That's what increases the appraisal. That's what makes an investor want to go buy it for a 6 or a 7 cap if we go to resell it at some point down the road. So I think that makes the world go round. And what I try and do is support the heck out of my brokers. So I do a lot of marketing. Like we talked about, that might be direct mail. That could be Facebook videos. That could be putting them on LinkedIn and celebrating their success. Hey, another deal just got done here. The landlord is willing to throw dollars at the build out. The landlord is willing to help you with your fixtures and your finishes. So all those things, are giving us the best value in the area. So I could choose the building across the street, or I could work with this guy, who's cutting more favorable deals.
Yeah. That's great. I agree with you on the broker side. I wanted to play devil's advocate there and ask why, right?
Yeah.
Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my 2 podcasts, Real Estate Investing for Cashflow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASHFLOW without the O. Again, that's 833-CASHFLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. How do you select the right broker for any given retail center in a given market, right? I mean, I know you're in a couple of different markets now. I know in the greater Phoenix area, but is there a broker selection process that you go through to identify the right man for the right job or right woman for the right job?
Yeah, absolutely. And again, we're fortunate that the data is so robust now. Like I can just pull up in CoStar and see who is the top leasing broker or landlord rep in this neighborhood.
Yep.
And how many deals have they done in the last 12 or 24 months? And then who's the top tenant rep in this part of town? Who has sold the most listings? What have they sold it for? Who's doing more buyer side representation? Who's doing more sell side representation? And I suspect that most of my brokers work and represent many clients. And so that has been, part of my strategy is I want everyone in town to know me. And I want them to think of me when they see a value add shopping center that's underperforming. Mm-hmm. When they've got a tenant who needs space, I want them to call me about all our buildings that have vacancy. Because when we buy a building, it's going to have vacancy. That's part of the business model. And just know that we're doing it fairly. We're compensating people well, and we're rewarding people for a job well done. So I was having this chat with Jeanette the other day. She's like, "Hey, Sean, am I going to get the relist on this new deal? I brought it to you." And I was like, "You're right." And that will demonstrate not just to her, but to all the folks in town that, if you bring us great deals where we can make a good return and great returns for our investors, it makes sense to pay you hundreds of thousands of dollars in commission.
Sure. No, absolutely. Absolutely. It's a two-way street, right? Mm-hmm. Fantastic. How about the property management side of this business? Being that it's a triple net scenario, that you're not, the tenants are in charge of most, if not all, the upkeep, depending on your lease agreement and how you have it written. Is it necessary to have a third party management company in place when you own these types of assets?
Certainly it could be done in-house, or, the owner can handle it. There's pros and cons to that for sure. With my amount of deals right now, I have chosen to manage it in-house. Ironically, when you're doing your tenant interviews and you're solving some of their problems and you want to have a really good pulse of what's happening with the business, I find myself talking to them, once a month anyway. Mm-hmm. And so it didn't seem like that much incremental work to handle some of the property management. To your point, in retail, there's just not quite as much to manage as, let's say, an apartment building or single family. These people aren't living here; they're just operating their business. So
right.
We have porters come take out the trash. We have landscapers do the landscaping. Like managing a handful of subs that are more or less on a monthly retainer is kind of the gig. Now, that being said, I'll probably move to a property management model down the road, because every minute that I'm spending dealing with the maintenance is a minute
buy more deals.
Buying another deal. And that's where the big paydays come, right? I make my money and my investors make their money when we're buying more deals at a deep discount that we can add significant value to.
Got it. And what are you seeing in the greater Phoenix market? I mean, this is kind of a loaded question because it's all... every market, even sub markets in the Phoenix area, different than the next. And but generally speaking, when you're looking for a value add deal, what kind of going in target cap rate are you looking for? And then ultimately, what kind of returns are you seeking in the first, let's say, 12 months or 24 months once you get it stabilized?
Yeah. So in Phoenix, I think today, we're recording this in February
2019. Yep.
Deals are probably trading in the low sixes, maybe high fives, mid fives for a Starbucks or a Chipotle. Mm-hmm. You do that deal in Orange County, it's much lower. If you go out to like a multi-tenant retail or maybe a lower quality or tier of tenant, it'll go up into the mid sevens. Or I've seen some deals that just recently traded at an 8 cap, and those are for more stabilized assets that are, maybe 100% occupied or 95% occupied. Mm-hmm. When I'm buying something that's value add, I'm looking a lot less at the cap rate today.
Sure.
And more so at the pro forma value of what it could be worth tomorrow. Mm-hmm. And so, it's abysmal. It might be a 4 or a 5% cap on the buy, but I can turn it into a 12 cap by leasing up the 50% of space that's vacant.
Yep.
And by doing, a couple $100,000 in CapEx or renovations. And so, I'll think about some of these deals that have been done recently, buy it for $2 million and I can increase the value to 3.5. Buy it for $2 million and I can increase the value to 4.5. And it's going to take a lot of build out and time and construction to get that done. But that is significant, value creation by doing that leasing.
Mm-hmm.
And so I look at that on the back end.
And so what is the ideal size now that you're looking for? The first building was a 20,000 square foot. I know more recently you've done some larger, I think 100,000 plus square foot centers.
So I stayed in that same size.
Okay.
So both of those deals I bought just recently were sub $5 million. Well, in fact, they're almost exactly both $2 million, like almost to the penny. And so one's a 20,000 foot building, so about $100 a foot. The other one was a 16,000 foot building with an additional pad site in front of it where we could build a Starbucks or a Chipotle, or maybe do a deal with In-N-Out or McDonald's or something like that. And so you look at the price per pound on that, but my banker has urged me to go bigger. My mentors and coaches have suggested go bigger. I want to be in, more desirable locations so we can attract higher quality tenants, so that we can either resell them for lower cap rates. And so I think, my next couple acquisitions will probably be in the 3 to 5 million range, kind of the sweet spot. Okay. And then it goes from there. It takes just as much time to buy a $2 million deal as it does an $8 million deal.
Yep.
And, as we go bigger, there's more cash flow to share with our investors. There's better depreciation when we do our cost seg studies. And there's more to go around and more people who we can get great returns for. So
yeah, absolutely.
It's a comfort zone thing, right?
Yeah.
And a little bit of balance sheet. Like, my banker needs to see that we can, support these buildings if something happens. And, in many cases, we're personally guaranteeing these loans. And so you got to have the balance sheet and the net worth to back it up.
Yeah.
Or find a partner who does.
Sure. Absolutely. What excites you today about the market that we're in? I mean, the part of the cycle, given the location where you're investing in the Phoenix market, and then on the flip side of that question. So again, what excites you? Generally speaking, what gets you all jacked up in the morning about where we're at today and the opportunities that exist? And then on the flip side, what scares you? What keeps you awake at night?
Good questions. It sounds almost dorky, but I'm excited about just doing deals, right? Like when I sign a lease in one of my buildings that has vacancy, it can literally add hundreds of thousands of dollars of value to that shopping center. It increases our cash flow by thousands of dollars a month in many cases. So I get to report back to the missus and say, hey, hun, guess how much our passive income just jumped this month? And the same goes to our investors, right? I say, hey, guess what? Our distributions next quarter are going to be that much juicier because of the deals that were recently signed. And I get excited thinking about the fact that I'm really just getting started. And the first few deals are by far the toughest, right? You're unproven. The brokers don't know you. They're going, hey, what do you own right now? And you're, I got one deal, or I've got two deals, or my background's in single family, and this is my first purchase in Arizona. So we've made it past the hardest part, you could say, and so we're getting better, earlier looks at higher quality stuff. People know my buying criteria. They see a track record now. They're seeing deals go full cycle. Investors are getting more comfortable, and so as you think about going from just a couple of shopping centers to half a dozen to a dozen of these, or maybe doing apartments and some of these other things. Like I almost think about the rat race, right? And Rich Dad and the whole game. It's like, it's going to get wild because doing the 4th, 5th, 6th, 7th, 8th building is not incrementally that much harder. In fact, it probably gets quite a bit easier. So that gets me all jacked up. I think about what that does for my family, what that does for, our kids, what that does for my investors, who are banking on this for their retirement or for their trajectory to leave their day job at some point, going, hey, Sean's out there every day grinding on these centers, like increasing our portfolio and our net worth. So that gives me the warm, fuzzy feelings. What scares me? Screwing up. Like
fair enough. Yeah.
Making a bad buy. I had a couple of those in my single family flip days where it was very speculative and we missed the mark on the numbers a little bit. And it's like, you know what? We thought the construction was going to be less. We thought it would sell for more. We thought we'd get it done in 6 months. It took 9. And that essentially gobbled up all my profits. So I'm sitting here working for 6 months for no payday. My investors are still made whole, but that's not fun. And you definitely don't want that to happen on a $3, $4, $5, $6 million deal, right? And so I spend a lot of time like stress testing these deals and making sure, in the worst case scenario, are we still going to be okay? Like, could we ride this out? If the deal takes 3 years to turn instead of 2, if it takes 5 years, if we decide to hold it for a while, what are, some of the alternative solutions for this building if it doesn't go, with our most likely scenario?
I thought you were going to make a joke and tell me that it's your newborn that keeps you up at night. So she 8-month or 18-month?
Well, we've got an 18-month-old, and my wife is 2 weeks out from our second kid.
Oh, wow. Congratulations.
We have a daughter on the way. The rest of this year is just going to be wild.
Oh, man.
Thank goodness the portfolio is pretty well optimized and performing at this point.
Yeah, no, that's right. Congratulations. You're going to be a busy man. Already are, but about to get busier. I've got a 2 and 5-year-old, so I've been there, done that, just moving on slightly past that stage at this point. But it's still, it's a lot of fun, but challenging as well. But
I have a newfound respect for people who've built real estate businesses and portfolio. It's like I had a jump start, fortunately. So we have good momentum at this point, and the resources to have some help. But a lot of respect to all the parents out there.
Yeah, I'm gonna add a layer to that. Mad respect to those that have built a business that have young kids, that have a family, that have been present with their family as well, right? Like not that just kind of go off and, the kids don't see their father for like 10 years while he's building this business, but truly being present for your wife, being present for the children, and being present for your business, for your employees, for your investors. There's a lot involved there. It's very doable, but it takes a lot of focus and a lot of time and a lot of energy. So with that, you sound like I can just tell just by your personality that you're very involved with your family and are very involved. So
I couldn't agree more. I mean, I'm fortunate now that we were able to set up, a nice comfortable office here at the house. I can see him after breakfast. I can see him for lunch. The nanny's here, and so we can be together. And what's wild to think about is just like us and other investors leading by example, right? And showing him, how we're working smart and how we're, buying assets and creating income and a portfolio. I don't know if we give it all to them, make them earn it, right? And so there's a different problem to solve there. But you can only imagine, had we grown up, and I think like a lot of people, where you're watching, what we're doing with multi-million-dollar transactions, and that's just the norm. So for him, if he starts doing this business, he's like, why would you do anything less than a $10 million building?
Yeah.
He doesn't get out of bed for less than that. And I would love to give him that unfair advantage and jumpstart it.
Sure. No, I agree with you. That's awesome. I love it. So Sean, we're running out of time here. And so I want to enter into what I like to call the golden nugget segment of the show. This is also where we wrap things up for the day. And you share a lot of great information today, so I appreciate that. But if you had just one final golden nugget of advice or wisdom that you can leave with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
I mean, everyone probably says take action, right? Like that is such an important thing. But, as you really think about, maybe what has stopped someone from taking action in the past, like you've been thinking about doing real estate for 5 years. You've been thinking about investing, but you haven't. You've been thinking about writing up an offer, but you haven't. Like, why is that? Oftentimes you can track it back to fear. And they have fear of failure. And so what are some things that you can do to shore those up? And like what really helped me move forward and to expand my comfort zone was surrounding myself with superstars who'd executed time and time and time again. So I don't know if that's a coach or a mentor or investing with someone who has done, many projects successfully, where you can say, hey, I've got a Jedi council of people that I can turn to for guidance, for support, for help, for questions to get me to that point. And, maybe you're not going to keep 100% of the deal, but you get one done.
Yeah.
And then you can say, hey, I've participated in this, or, we're passive investors in a much larger transaction. So we could see how they manage dozens and dozens of investors, and what are they doing on $30 million assets that we can mirror and model on a $5 million asset.
Yeah, I love that. No, that's fantastic advice. Yeah, that's interesting. You mentioned about getting involved in that passive investment. I'm assuming that's not the only reason you got involved in that, but just the benefit that you gain by surrounding yourself with folks that are at a different level than you are in that respective niche, right? And just seeing how they run a multi-million-dollar company, just surrounding yourself with those folks that are where you want to be at some point in time, right? And again, that could be a mentor, could be a coach, could be a partner. Comes in many different varieties. But in any event, taking action is the first step, right? And that means taking action, getting out there and surrounding yourself with those folks that are doing what you want to do. So I think that's great advice, Sean. And again, really appreciate you coming on the show, man. It's been a lot of fun. It was probably overdue, but I'm excited that we finally got you here. And for those folks that want to learn more about you and your company and what you guys have going on, is the best place to reach you at your website, simplifiedproperties.com?
Yeah, at Simplified, I've got all the links set up. People can book my calendar there. They can reach out. And of course, I'm on all the socials. So, add me on LinkedIn, connect with me. I think I'm on Instagram a little bit. I'm trying to up my game a little bit, but please reach out, say hello, connect. Let me know if you have questions about what we talked about, or just want to talk shop.
All righty. Fantastic, Sean. Well, thank you again. It's been a pleasure having you, and look forward to staying in touch, my friend.
Likewise, Kevin. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.